Planning to own a car wash? You might want to think twice. The pitch is simple. Build a tunnel, park some vacuums out front, and let cars drive themselves through a wash that mostly runs itself. No scrubbing, barely any staff, and a stack of subscribers paying you every single month whether they show up or not. It's the same boring wealth fantasy as half the businesses on this channel. And the US car wash industry backs it up on paper. Over $20 billion a year in revenue, and still growing. But in that same industry, over the last 18 months, one of the biggest names in car washing filed for bankruptcy, and another sold off its entire car wash business for a fraction of what it spent to build it. So how does an industry that size produce outcomes like that? That's what we're figuring out today. And the answer isn't about the washing. It's about how fast this business got built, in a subscription trick that works a lot like your gym membership. Americans now have close to 290 million vehicles on the road, and the average car on the road is older than it's ever been, over 12 years. Older cars need more maintenance, and more owners who'd rather pay for a wash than do it themselves. The first cost, the one that hits before a single car pulls in, building an express tunnel from the ground up runs millions, and the site matters as much as the equipment inside it. Let's start with what this costs to get in. A ground-up express tunnel, the dominant format in 2026, the kind with a conveyor pulling your car through automated equipment, runs somewhere between $3.5 and $10 million or more once you count land, construction, and equipment. Just the tunnel equipment alone runs $500,000 to $2 million. And the site has real requirements. 35,000 to 50,000 square feet minimum, with traffic counts of at least 25,000 vehicles a day passing by, ideally 40,000 or more. Miss that traffic threshold and the equipment doesn't matter. Nobody sees you. Buying an existing wash is the more common path in. On the open market, the typical sale runs around $857,000 on median revenue of $710,000 and median owner earnings of $200,000 a year. Financing is usually an SBA loan, the 7A program for acquisitions under $5 million, the 504 program for new construction, with 10 to 15% down. Now, you'll hear that car washes run incredible margins, 40 to 67% EBITDA, among the best of any small business. That's true. But that's cash flow before debt service, on an asset most owners financed rather than paid for outright. Once the loan payment enters the picture, what actually lands in your pocket is a lot thinner than the number that gets thrown around. There's one more number worth knowing before you buy in: what these businesses sell for. At the height of the boom, buyers were paying anywhere from the mid-teens up to more than 20 times EBITDA for a car wash, pricing it like a software company, not a business that scrubs cars for a living. Those multiples have dropped hard since, down to somewhere around 5 to 7 times EBITDA for even the best assets today. That gap between what people paid at the peak and what things are worth now is most of the story we're about to get into. The hidden trap, the one that's quietly wrecked some of the biggest names in the business. This industry got built faster than the traffic could ever support. Almost every first-time owner gets caught off guard by the same thing. Break-even takes a lot longer than the pitch implies. A new express tunnel typically needs 18 to 36 months to break even, and needs to be washing 4,000 to 6,000 cars a month just to get there. That's not revenue. That's the volume required before you've made $1. And every one of those washes carries a real cost. Water, chemicals, and electricity run $1 to just over $3 per wash. Most states now require water reclamation systems, and even with one installed, water alone eats 5 to 10% of revenue. A well-maintained system can recover 70 to 85% of the water used per wash. Skip one, or run an aging system, and that revenue hit gets worse fast. But the bigger risk isn't any single line item. It's supply. Private equity discovered this business between 2019 and 2022 and started building at a pace nobody's traffic could absorb. 850 to 900 new tunnels a year at the peak. In some suburban corridors, 3 or 4 express tunnels now compete over the same handful of streets, chasing the exact same subscribers. That's not a hypothetical. It's exactly what just happened to some of the biggest names in the industry. The real engine, the one that turned car washing into a subscription business, the money isn't really in the wash. It's in how many members never show up. So if the buy-in is steep and the break-even takes years, how does this business actually make money at scale? The answer is memberships, and it works almost exactly like a gym. At the largest operator in the country, roughly 75% of all wash revenue now comes from unlimited monthly memberships, not single washes. Industry-wide, successful express tunnels pull 30 to 60% of revenue from memberships. The average plan runs about $25 a month. The average member washes their car 2.6 times a month. Do that math, and it's roughly $300 a year per member, against a marginal cost of about $1.50 per wash. Here's the part nobody advertises. The members who wash constantly aren't actually the profitable ones. The profitable ones are the members who sign up meaning to use it every week, and then don't. Same as a gym membership. You're not paying for the treadmill. You're paying for the version of yourself that was going to use it 3 times a week. Car wash memberships run on the exact same math, and operators know it. Some markets see membership penetration approach 70% of regular customers before it plateaus, and even a modest 5% conversion rate can lift total revenue by roughly 40%, because the fixed cost of running the tunnel doesn't move either way. Membership churn across the industry runs 3 to 8% a month, and roughly 9 in 10 members say they plan to keep paying. Retention numbers that rival streaming services and gyms for exactly the same psychological reason. The real money in car washes. Single washes barely cover the cost of running the tunnel. The membership is the actual business, a flat monthly fee sold on the promise of unlimited use, bought by people who mostly won't use it. That gap between what members pay for and what they use is where the profit lives. You can see exactly how this played out at scale over the last 2 years. In February 2025, Zips Car Wash, one of the largest privately owned chains in the country, filed for Chapter 11 bankruptcy carrying $654 million in debt, built almost entirely from an aggressive acquisition spree during that same building boom. Driven Brands had it worse. After spending roughly $3 billion assembling its car wash business, it sold the entire thing, about 400 locations, for just $385 million. And in February 2026, Mr. Car Wash, the largest operator in the country, went private in a $3.1 billion deal. That one's a different story. Analysts have called it less a sign of distress and more a business that simply works better outside the pressure of public markets. Same industry, same subscription math, 3 completely different outcomes, decided almost entirely by how much debt each company carried into a market that got saturated faster than anyone expected. And there's a strange wrinkle in all of this. Even after everything you just heard, the largest single operator in the country controls only 3 to 4% of the express tunnel market. Every private equity-backed platform combined still owns less than a quarter of it. This was never a monopoly story. It's a story about a handful of specific companies borrowing too much, too fast, into a market that filled up quicker than anyone priced in. So let's run the 2 real outcomes for someone buying a single site, not building an empire. The optimistic case. You buy an established express tunnel with a real membership base already built, say 1,500 to 2,000 active members, in a market that isn't already saturated. Revenue lands around $900,000 to $1.1 million a year, more than half of it from memberships. At a strong 55% EBITDA margin, that's roughly $500,000 to $600,000 in cash flow before debt service. After a typical loan payment on an acquisition in that price range, you're clearing a genuinely strong 6-figure income, and the membership base keeps the business stable, even through a slow, rainy month. The realistic case. You buy or build in a market that's a little more crowded than you realized. Membership growth stalls in the low hundreds instead of the thousands, because two other tunnels within 5 minutes are chasing the same customers. Revenue lands closer to $700,000 to $800,000. Once debt service is subtracted, what's left approximates that median owner earnings figure of $200,000 we mentioned earlier. You're not underwater, but you're a long way from the six-figure cash flow story that gets pitched to first-time buyers. And any additional debt or an unexpected equipment failure eats most of what's left. So is it worth it? If the pitch in your head is, buy it, automate it, forget it, that's not this business. This is a capital-intensive, real estate-driven operation where site selection and membership execution matter more than the equipment itself. The good news? The survival math is genuinely decent for owners who buy an established site with a real membership base, rather than building from raw land into an already crowded corridor. The failures we just walked through weren't demand problems. Americans are washing more cars than ever. They were debt and location problems, stacked on top of each other. For someone with the capital and the patience to pick the right corner, this can be one of the most durable small businesses out there. For someone chasing the set it and forget it version of the pitch, the tunnel runs itself, but the business absolutely does not. Remember this: a car wash isn't a wash business. It's a subscription business with a wash attached, sitting on a piece of real estate that only works if the traffic count and the competition support it. Get the site right, and the memberships do the rest. Get it wrong, and you're just another overbuilt tunnel in a corridor that already has 3.